So the stock market is down significantly. And while I don't think anyone predicted that it would get this low, it's like a serious crash. It doesn't mean you're never going to make money in the stock market again. And one good thing to be right now is a dividend investor because in all likelihood, dividends are still going to be paid. Okay, so before we get into this video, someone said I should be putting disclaimers into my videos. So anything here is my opinion. Because I talk about finance a lot and investing, you still need to do your own research and make your own financial decisions. But you're smart, I know you do this already. So my personal opinion, is that I don't think that the market is going to get a lot lower. Of course, it's really going to depend what happens with the coronavirus going forward, but I feel like people are taking that much more seriously now, and that's a great thing. So the average drop in a bear market crash is around 20%, but 30% is not unusual now, and that's where we're at now. Now, of course, there have been some crashes that have gone as low as 50%, so I'm not saying that it can't go that low. I just don't think that it will. I think it's going to hang around at this level for quite some time until things start to stabilize. So while there's been some significant drops, there have also been some upswings. Not as many, of course, but it just seems like investors don't really know what's happening right now. Even in one day, it can swing as much as 10% from open to close. This just happened recently in the ASX 200, where it dropped 7% on open and then went to finish the day 4% up. I've not seen anything like that before. It's crazy. The day traders will be having a field day. So right now it's very jagged, very reactionary. It changes based on what governments are saying, what economic stimulus packages they're talking about. And of course, it's reacting very strongly to how the world and the governments are reacting to the coronavirus and what they're doing not only for the health of the people, but also for businesses. Because some businesses are going to suffer temporarily. Probably not toilet paper or hand sanitizer companies though. So it's completely unpredictable right now, which is fine. I don't care to predict what's going to happen anyway. I usually just react to what is happening. But what we do know is that companies are still paying dividends. Now, sure, dividends can change during a recession or a downturn. That's not unusual. And yes, they can even stop. But generally, companies will not do this unless the situation is absolutely dire. So cutting a dividend is the last thing that a company wants to do, especially when the stock price is falling, because they do not want to lose more investors. So instead, what they'll do is hold on to the dividend payment for as long as they can. Since most companies that pay out a good dividend are long-standing companies that have been around a while, these companies have the money to do so. They have the backing to ride out these sorts of crashes. And because dividends are paid out of earnings, large companies with a high market capitalization, which is one of the things that I look for, they can still afford to be paying dividends even if they're not making a profit right at that moment for usually quite a significant time. But yes, that still will depend on how much that business is affected and how long the crash is going to last. So let's say this crash only lasts a few months, a vaccine has been created, or all of this social distancing and keeping people away from crowds really works in eliminating the cases. It likely won't impact dividend payments at all. If the crash lasts longer, say a year or so, then yes, dividend payments will probably be affected then. Not every company is going to lower their dividends during this time, but it could be a possibility. They will, however, reduce it rather than get rid of it altogether though. It is very rare that a company during a crash will decide to just eliminate the dividend altogether. Investors would go nuts and it would actually probably break the company. They're not going to do this. At least the bigger companies that can afford to ride this out won't be doing this. So stick with the larger companies. So let's talk a little bit about what happens with yield during this time. So the dividend yield of a stock price is based on a formula of the annual dividend of the share by the stock price, the current stock price. So it's just a calculation at any one time. So if investors want to know what the actual dividend yield might be at that time. So obviously because of this, the dividend yield is constantly changing because the stock price is constantly changing. So if the dividend payment hasn't changed, but the stock price goes down, the yield will go up. So basically, if you buy at a low price, you're getting a better yield for your money. So some people think that when you hold a stock, what you get paid each time is based on whatever the current yield is, but that's actually not correct. Because as we know, it's just a formula based on what the current stock price is and what the annual dividend has been. So once you hold the stock, it's no longer as relevant because you get paid on how much of the stock that you hold not what the dividend yield is at that time. So if a company pays out $5 a share and you have 100 shares of that company, you will get a dividend of $500. It doesn't matter if you bought that stock at $50 or $100. You get the same amount per share based on how much of the stock that you hold. So clearly it's an advantage to buy low because the yield that you get will be higher based on how much you initially put in. Sometimes you can actually get a pretty awesome return for your money. So yeah, the quoted dividend yield is really only relevant when you're buying, so you can get an idea of what return that investment is going to make for you over the next 12 months or so. Let's look at an example. I recently did a video looking at different stocks in the ASX 200 that had a dividend yield of 5% or more. This was before the crash. So let's go and have a look at those yields now. Given that the dividend payment hasn't changed, only the stock price has changed. On the 7th of February, ANZ's yield was 6.2% and today it was 8.7%. BHP's yield on 7th of Feb was 5.1% and it's currently today 6.6%. On the 7th of February, NEC's dividend yield was 5.5% and it's now 8.8%. WPL's dividend yield was 5% on the 7th of Feb and today it was 7.2%. So if you are a dividend investor, it's actually not a bad time to buy because you're going to get a better return from those same companies. But again, that's up to you, my opinion. So one other good thing about being a dividend investor at this time, while you're waiting for the market to recover, you will still be receiving dividends. That means that unlike someone who's just interested in the stock price, you're going to be recouping your losses much faster. So while everyone else is focused on the price going back up, and it will, all crashes recover, the dividend investor has that advantage because they're still getting those regular payments. So let's talk briefly about reinvesting the dividend during this time. It's actually a pretty smart strategy to reinvest the dividend rather than take the income during this time. The reason being, kind of like a dollar cost averaging strategy, if you're continuously buying more stock at this time at a lower price, the amount of stock that you hold is going to be higher. And so you're going to be able to get more stock at a lower price as the dividends are being reinvested into the company. So when the market does rebound and the stock price goes back up, you'll be holding a lot more of that stock and therefore your profit is going to be higher. So reinvesting the dividend during a bear market is actually a pretty good strategy rather than taking the income. Of course, if you need the income, that's a different story, but if you don't, it's probably worth doing that because that way you will be rewarded once the prices go back up. I, of course, will be taking the income though because that's what I use. But if I didn't, reinvesting would be a great strategy right now. So that's really basically what will be happening to the dividend payments during the crash. It's going to depend largely on the companies that you hold and how they're faring during this period. How long the crash is going to take place, nobody knows that. I originally thought it was only going to probably last around 6 months, but I have a feeling it might go closer to 12 months now. We don't know yet if companies are going to drop the dividend. In past recessions and market crashes, sometimes they have and sometimes they haven't. So it's just sort of a waiting game now to see whether they will. It's unlikely that the larger companies will right now, but again, it's going to depend on how long it lasts. I hope this has been helpful and I hope everyone is staying safe and not getting too bored stuck at home. Have a great day and I will see you in the next video. Take care. Bye.